Right, we now move on to Chris Gadd. Chris also comes from a farming family up around Boston in Lincolnshire. After that, he worked as a grains trader for ADM in the UK, and he now is Macquarie's analyst for grain and oilseed fundamental research here in the UK. So, Chris, I'd like to hand over to you, please.
Thanks very much. So in today's presentation, I'm going to briefly go through our outlook for the next 12 months for oilseeds, and then move on to look to the longer-term drivers of the grains and oilseed complex, looking at the way prices are likely to evolve over the next 5 to 10 years. So in the near term, from an oilseed perspective, we've come off the back of an absolute disaster in 2012. 2012 was the epitome of weather problems all around the world. We saw terrible state of affairs for the South American crops with poor Brazilian and Argentine production, then moving further on looking towards the US as well, where we saw deterioration in yields. Not only that did we see poor soy production, we also saw poor sunseed production in the former Soviet Union, but then on top of that, rapeseed production in general was pretty poor. So when you look to the 2013 season, it's not really very difficult to get anything better because it was a disaster. So when we looked at that, we really do see from a global perspective that rapeseed production, sunseed production is seeing by far an improvement. We saw a far larger soybean crop in South America early on this year, so the pipeline and inventories have been rebuilt. The problem is now, though, there is uncertainty about the US. So the core crux of the actual oilseed market this year will be driven by what goes on in soybeans. We're seeing that rapeseed prices, sunseed prices, both in their seed form and their derivatives, are tracking back onto that soybean price as its level of support. So the main concentration of our discussion today is really going to be regarding soy. So starting off where the problem lies, looking into the US balance sheet, we do see that whilst we are going to see an improvement in ending stocks, stocks today should get up to about 163 million bushels from the levels that we saw last year of only about 140. But in reality, there's an awful lot of uncertainty that relies with this number. We could quite easily get up to 200 million bushels. We could quite easily once again get down to 100 million bushels, depending on where US yields really lie, and then on top of that, where South American production comes in early 2014. Reality of the situation is today that US yields are improving. We see the situation going through in the US that without the USDA, we're struggling for information. The market is bereft of resources to try and tell what that yield is at that most critical time period. We are in a reasonably fortunate position that we have a fairly good information tract going through the US. We cover the insurance through one of our subsidiary businesses, around about a third of production, through 38 agents. So we've been intensively surveying these guys to make a replacement for what we'd normally receive through from the USDA. So the reality of the situation is today that early in the year, as we went into August, we saw no precipitation come through the US. Yields were likely to be tracking back to around about 40 bushels, 39 bushels an acre, very similar to last year for the US soybean crop. Thankfully, though, early September, good rains came through, and in conjunction with a later planting period this year, those September rains did turn out to be what an August rain would normally be. So reality is, through that time period, we have been seeing US yields tick up from our surveys, and we would expect whenever we get the next WASDE report, be that in November or even December if the US government doesn't return to business in the next couple of weeks, we will see an improvement in that US soybean outlook. That is, though, required to sort of stabilize the market. We have heard, though, there's many sources out there talking far higher yields than we are. We're at 42 bushels an acre. Many are 43, 44, to the extent of that possibility. I draw your attention to the chart that's fairly complicated up at the top left of the page there. Basically, what we're showing there is the distribution of yield between its pod weight and its pod count per plant. So reality is that with the lack of precipitation that came through, all of those top nodes, those top pods that existed in the US were aborted, and we saw that we shifted to the top left, to the left-hand side of the chart. But as we get lower pods, we also incentivize a higher pod weight, just like we did last year when we saw pretty much bang-on record pod weights. Reality is, though, where this chart stands today, we've got a 42 yield. We've got an increased pod count from where the USDA are because some of those September rains should have helped some of those top nodes develop. Reality is we're still pretty much bang near on record pod weights with no rainfall in August. So we struggle to get too excited about how far US yields can really go. So that's why when we forecast in the bottom side there, we're looking for stocks to remain fairly close to pipeline levels. And other risks that certainly do sit out there is that there was a far larger proportion of double crop soybeans that was planted in the US this year in comparison to normal, helping sort of cause more sort of eradication from a yield perspective. So when we flip back to our S&D, we really are in a situation where demand has to be constrained. The US, as its role into the international market, has to be pushed into a destocking phase, and then also forcing more demand to be held off until we get the harvests in 2014 from South America. What we do, though, see from a domestic standpoint in the US, we are seeing the influence of the rally in soy prices that we did see. So on the top left-hand side, we're really seeing that from a feed compounding perspective, the US compound is at its highest incentive today that it has been for a very long time to start to substitute away from soy meal and add more corn into that feed ration where they can, and then also on top of that, other meal components, specifically Canadian canola meal. Also, we see in the blue line, this data has unfortunately run out when the USDA closed down, but we did see an impact in export sales. As soon as we saw the large rally in soybean prices, the Chinese stepped away, moved from buying US origin beans, and then concentrated heavily on buying post-February origin, South American origin beans, specifically Brazilian. There is, though, tightness in the US balance sheet. Whilst ethanol has come up against the blend wall, and we are seeing that situation is over the last few years has slowed down in terms of demand, biodiesel demand in the US is really starting to take off now, and it's becoming a far larger component of the soybean S&D. Reality is, from a soy oil perspective, the US is turning into a very domestic-orientated market. Their export competitiveness has been restricted all throughout the season. As we see on the bottom right-hand chart, they've been very expensive against Argentine soy oil. And the big driver of this is that the continued increases that we're seeing in the mandate, going up to about 1.6 billion gallons of biodiesel will be required to be produced in 2014. This is taking all of that domestic supply of soil that is being produced that would normally go into the international market and keeping it well controlled in the US market. We do, though, see that we notice from this chart from a soy oil perspective where we do have some bullish expectations through the next year, is that the US is just about becoming competitive with Argentina again, getting that export program they really can't provide. And on top of that, we're really seeing as we move further down the scale that palm oil is far less competitive against soybean oil this season as well. So all of that vast substitution that we saw all around the world to more palm oil inclusion in every single vegetable ration that we could really use it in is likely to cease and backtrack to a certain extent. So that was all the bad news. The US is very tight again. It has been supporting prices. Now the response. And South America provided a huge response last season, and they are likely to once again. Jack touched on the actual corn price ratio that we see in the US, which is giving that farmer in the southern regions of Brazil, where they're planting corn and soybeans in a rotation, to switch away from corn, like they have consistently done over the last few years, into soybeans. In this region, we're expecting around about 750,000 hectares of area to be switched. Brazil, though, is not developing a large soybean production because it's just switching away from corn. It's because it is that marginal region of the world that is able to respond to these high prices, bring on huge tracts of land that are available into the interior of the country and bring them into production. This is what this chart is really trying to tell you here. So on the left-hand side, we see in US dollars the price of soybeans. So whilst the blue prices from last season, we saw very high levels. As we've gone into the 2013-14 season, we've seen far lower prices as we've seen a rebound in production, really led by the South American crops earlier this year. But In Brazil, they aren't seeing these prices. They're seeing far higher soybean prices because of the massive devaluation that we've seen through the real through the last couple of months. So in reality, you can see from that chart, the Brazilian farmer from a total flat price level has got around about the same price incentive this year as they have done last year. So not only do we expect around about 750,000 hectares to be switched in the south towards soybeans from corn, those marginal regions in Mato Grosso, Mato Pitu, Bar in the northern regions should see another 750,000 hectares of additional soybean area brought online, taking us to around about 29 million hectares of soybeans to be planted in Brazil next year. That, as such, is allowing them potential to produce at least around about 87 million tonnes. That, in general, would be very bearish to the market, so once we get through to the South American period of the season, if we realise this size of crop, prices should certainly correct. We have, though, got to get there first. We have a weather market to get through, and nothing, as we've seen over the last few years, is certain about yields. And on top of that, as you do though see, at the end of the 12-13 season, Brazil is going to be finishing with a very, very tight ending stock, pipeline levels. They've got another sort of 3-4 months to go until the end of their season, and they, reality, have already run out of soybeans. A lot of that has become, because what you see on the chart on the left-hand side here is Brazilian exports by month. The red bars are indicating how much volume Brazil has really been shipping this year. There's been port lineups, a lot of people criticizing Brazil for problems with their export infrastructure. Reality is they responded in a big way, exporting year on year to date 10 million tons more beans. The problem comes though for the market is where we're sort of left with this tight South American production, tight US production once again, moving to a looser balance in the US. That transition period is going to be all important. So Brazil's exports in February and March will be critical. Last year, we saw a bullish price response as delays went through the harvest, problems in infrastructure in the interior, slowed down that export program, and required the Chinese to move from what they'd purchased out of Brazil, taking more volume from the US. This variable here is mostly one of the biggest, most important things, bar South American weather, to affect the soybean prices. If Brazil is able to export that 5.3 million tons we expect in February and March, then happy days. We will see bearish prices coming through. But the reality is, though, if Brazil is unable to meet that requirement, you'll see that flow be turned back to the US, tightening the balance sheet even further, and ensuring a very tight supply set in the US and very much a far tighter S&D than we'd really like. And then the volume that Brazil would have exported in February and March won't be able to be exported until far later in the season, into September 14, so ensuring a tighter S&D through the period. So the biggest things that we're watching as we go into the new year, obviously the way weather's developing over Mato Grosso, some delays to plantings, but should be fine. So the yield development there is obviously going to be critical, but further than that, how the weather in the southern ports is developing, the timing of the harvest is going to be crucial to how tight the US S&D really finishes. The bane of any oilseed analyst's life is certainly Argentina, because from a global perspective, even in spite of the situation that we've got developing in the US today, we've certainly got the picture that we should have a big surplus globally, because Argentina has a large supply, but unfortunately the Argentine farmer hasn't been a seller. They've restricted their supplies domestically, holding their production locally from a variety of reasons. So whilst the world should be an ample supply really of beans today, or at least far better supply than it is, the Argentine effect is holding prices up. So the reality of the situation is one of those other pivot points of the market is what's going to happen in Argentina. And then that takes every single analyst out of their comfort zone, because you move away from the reality of the situation where you're talking about fundamentals, weather to a certain extent, and the breakdown to your S&D, to talking about politics and farmer behavior and the regulation that sits within that country. So reality is Argentina's stockpiling. And the reason is the chart that you see on the left-hand side. The peso has continued to devalue. So the reality of the situation is in Argentina is the Argentine farmer is infinitely bearish his own currency. So if he holds on to his soybeans, which are US dollar denominated, he's actually taking a currency position and hedging himself. So we see that large rise in the peso is encouraging stockpiling domestically by the farmer. We've seen record sales of silo bags going through Argentina as they build this inventory. So that's really what we're seeing coming through today in Argentina. And we're seeing the stock build of meal building through the region. And that's why we're holding this large ending stock for both this year and next year in Argentina. On top of that, for next year, this movement in the peso is not only infecting them to stop selling, but on top of that, it means that every single input cost that they've got, from nutrients to seeds to chemicals, which are dollar denominated, are rallying dramatically, making it far more expensive for them to produce. And that's why we only have a very conservative yield estimate of around about 2.62. Moving on from the joys of supply to the joys of demand. The big story, which will be touched on later, is China. We have seen a large build in that huge flow that came out of Brazil, arrived in China, and that's what you see in those big spikes in those red bars, at record levels of imports by China in the last few months. And the consequence was the chart on the right-hand side, a massive build over the last few months of Chinese inventory of soybeans. Now that will be distributed internally into the system, but China is certainly far more plentifully supplied today than it was previously. And as we look through to the 13-14 season, we certainly can see some elements of strength of demand coming through in China, but we do though see on the left-hand side that hog margins were very negative for a sustained period of time last year, causing a likely contraction in the hog herd to a certain extent, but at the very least we should see no expansion in the region. So we're not seeing underlying huge proponents of demand coming through in China, which will certainly help in this tighter oilseed supplied market. We do though still see a large increase in soybean imports, up to 65 million tonnes. The reality being that we will see the inventory build continue that we've seen today, and on top of that, we will see that substitution effect that we saw away from soy meal to canola meal to chopra to corn in China, reversing as we move into the 13-14 season, becoming a far more soy meal intensive portion of the diet. Looking globally, Europe was a very weak importer of soy meal last year, but reality is that should remain the case this year as well, because not only maybe we're seeing some undertones of strength back in the feed sector in Europe, reality being though that we've seen a far superior size of local production, bigger soy, bigger sun, bigger rapeseed, far more domestic competition, so the European Union is becoming far less far more domestically orientated than internationally orientated for their meal supplies, helping control that import volume, but it is a required evil in this world of constrained supplies. As touched on earlier, we do though see that soybeans are the top of the curve. We see on the right-hand side there that rapeseed prices have tracked back aggressively to soybean prices. We see that the canola ICE contract in Canada is trading at a discount to Chicago soybeans, which is a very unusual state of affairs. And obviously giving that substitution effect, certainly in the US, to move more canola meal and less soy meal into the feed ration there. And this is because what we saw in Canada. We've seen this was the potential to what we saw last year, but unfortunately we lost the rapeseed crop at the last moment of the stage. This year we are seeing a far improved canola production. The likelihood is this production can continue to increase as we move through the season. I've heard estimates as high as 17, 18 million tonnes, allowing for a huge surplus of rapeseed in Canada, which will be very export competitive all around the world, taking any of that demand that would normally go into China, competing aggressively with the Australians as well. So keeping the rapeseed price in check versus the soybean price. So all in all, from a short-term perspective, the way we see prices is that we should likely see support coming through in the near term as we move through to the South American harvest. Any production problems that come through for South America, any issues that develop with those crops will certainly have a bullish connotation for prices. If everything goes well, if we receive average yields in the South American harvest, we should likely see prices continue to grind lower into the tail of the 13-14 season. And obviously the connotation is for the 14-15 season, with these high prices relative to the main competitor corn, we should likely see a large substitution effect to soybeans from corn in the 14-15 season, redistributing that balance and making the soybean balance in the US far heavier and tightening the corn balance to a certain extent. So that really is the picture for the shorter term. The longer term is far more interesting. We find it far more easier to sort of forecast for the longer term to a certain extent, because longer term weather becomes average and you can strip out that variable and you can look to the core fundamental drivers of prices. Obviously, the most talked about thing in world supply and demand over the last 5 years has been the emergence of the emerging markets and their dietary shift, moving to a far higher protein-rich diet and moving closer to what we see in the Western world. You do though see that on a protein, on a meat-based, a grain-weighted meat basis versus GDP per capita, China still, on those blue bars, remains right at the bottom left-hand of the axis, whereas the US right at the top. The consequence being, though, with over 1.5 billion people, a small shift there is a fairly sizable shift in the world economy of grains and oilseeds. Reality is, though, that when we break it all down, this is not an unusual phenomenon. We do see these events. We saw it in the 60s and 70s when the Western European powers became a far more meat-intensive diet and changed that ration. So if this isn't the story to higher prices, and the reality that we likely continue to see that this demand growth will continue through the next decade, at least in China, as they move to a far more westernized diet, what is the driver of prices? The reality is, and we've done a lot of work on this in our studies, demand does not really change that much over time. Demand is still continuing to grow at around about 2 to 3% every single year from a global perspective. What has changed is where that grain is required to be sourced from. Reality being that European Union, US, Australia, Canada, those traditional suppliers of seaborne grains to the world are becoming constrained as they either develop domestic biofuel policies, area becomes maximized, or yields become to plateau. So the reality is what's come through is that the world's consumer has been focused on far more marginal regions of the world, developing South America, developing the former Soviet Union, bringing this production back online. So what we really see here today is the good story. So the good story is that Mato Grosso, the area which has huge tracts of lands available in Brazil, sees far more rainfall than any other region of the world from a grains and oilseed producing perspective. And there's millions of hectares in this region that can be developed, brought online. And the double bonus is that this region of the world is close enough to the equator and still receive plentiful rainfall. They can harvest 2 crops in a year. So the soybeans that are being planted today will be harvested in January, and straight after that, they will go into it and plant the corn and get that double cropping element. So a very plentiful region for production in the world. This is the problem. And this is our conclusion about the entire grains and oilseed market. When you actually step back from it, the bullishness that we've actually seen in agricultural prices through the last 5 to 6 years has actually had very little to do with agriculture. We've had weather effects there that have driven the supply and demand, but reality is the longer term trend is not agriculture, because there are plenty of farmers in the world, and there are certainly there's millions of hectares that can be developed. The defining feature is infrastructure. Infrastructure changes everything. So reality being that when you look towards South America, you see on the left-hand side dirt roads that are being taken trucks down by. They are being developed very slowly. And whereas you see in the US, majority of transportation of grains is done by barge, very efficient transportation networks. In Brazil, the bulk of these grains are transported by truck, and that is just continuing to increase as that infrastructure is seeing really no improvement. And it's why you see the 40 kilometers of trucks parked outside the southern ports in Brazil. Because reality is, whereas you're moving 2,000 kilometers by barge in the US and paying $30 to $40 a ton, you're moving 2,000 kilometers by truck on dirt roads in Brazil and taking 5 days and costing $150 a ton. This transportation spread of $30 to $150 a tonne is purely the reason to why we see higher prices. That benchmark for what we require prices to move to ensure production development has moved. There are hopes. Brazil in the next couple of years will be developing new road structure. The BR-163 going north out of Mato Grosso, linking up to the northern ports, stopping that concentration in Paranaguá and Santos, will be finished. Having said that, this road was supposed to be finished 3 years ago and it's still not finished today. So it's not seeing that rapid improvement. They are starting to barge out and transship into ships out in the northern regions there. There are developments. But reality is these developments are coming on so slowly that the demand for those grains and oilseeds out of Brazil is growing far quicker than the infrastructure can keep up. Longer term, though, there are projects. They are building roadways, the roads that we discussed before. More importantly, we are seeing the rails being developed to go east-west and the big north-south links in Brazil. Having said that, the targets are for sort of these to be finished by 2017, but reality is they've not really started yet. And this is Brazil. They're certainly concentrating from an Olympic and a World Cup perspective today. So these projects are just being put onto the back burner. So as you see the chart that's most important on the right-hand side, this is the cost of production broken down from a global perspective. We see the US soybean farmer today is in the situation where they've got very high land prices, but that red area, that transportation cost is fairly small. In Brazil, it's fairly constrained. Reality is it's $150 a tonne. This is certainly the case that we see for soybeans, where there's a far larger flat price of the commodity, so you can absorb that $150 a tonne far more easily. If you translate this, though, to corn, it becomes a far more interesting question, because corn prices today are around about $200 a tonne for Brazil, $150 a tonne transportation costs, leaves them with $50 a tonne to produce that grain, which is nowhere near enough. So this land, and what we'll be surprised about for the 14-15 season, is how quickly production will go out that we've seen developed over the last few years. So our longer term thesis is certainly bullish. I'm not only just a farmer's son, but I'm a friend to the farmer as well, because we do see these prices being required to be higher to develop this land. Long term, we can take that production offline, but reality being, we need to incentivize this land to be produced and incentivize this infrastructure burden to be broken through. So reality speaking, I think we're here to say sort of in the near term prices may come lower, but corn price is averaging $6 to $7 a bushel and beans $13 to $14 a bushel through the next decade is a reasonable scenario. Weather and intervening surpluses will obviously have its impact, but these fundamentals won't change. And this is the state of play in agriculture from our perspective. Thanks very much.
Thank you very much indeed, Chris. Questions for Chris on a fascinating situation? Any arms? Yes, one here in the middle, please.
Paul Temple, HGCA board member. Can you just give me any views on currency, especially because of the problems that there are at the moment in the US?
I think I'm certainly no currency strategist. Reality of the situation is that the longer term, we are on a trend. The dollar has weakened dramatically as we saw this massive tapering policy, this quantitative easing policy that came through the US. As that reverses through time, we see the tapering coming through. The dollar will reassert itself against most currencies. The depreciation of most of the emerging market currencies, be that the real, be that the Mexican peso, against the dollar, and the Indian rupee and the Indonesian rupee as well, was largely down to those expectations of tapering. So I think that we are still, no matter what the situation is in the US, we are at a turning point where the dollar can be a strengthening currency once again, everything else depreciating against it to a far more normal level. And I think from our economist standpoint, reality is things are getting better. They may not seem it today, but we certainly do seem to have turned that hurdle. and gradually everything's getting far more stable. From our equities clients to our fund clients all around the world, they're far less fixated on the near-term shocks and more concentrated on the longer-term drivers of growth that we are seeing around the world, at least. So that pessimistic nature that we generally saw around the market is certainly beginning to become slightly more optimistic, except maybe sort of moribund at the present by the shutdown in the US.
Yes, one over here.
John Cunningham, a buyer of grains. The Argentine stockholding situation in a very, very tight market, they're holding it for, as you say, currency and taxation reasons. If you take the view that nothing moves in the same direction forever, is there a very real risk that if the peso stabilised at whatever level it does, that you could actually see a flood of outpouring of stock from Argentina, which could, in fact, bring markets off from the current very, very high levels?
Certainly from a soy meal perspective, I think that's the risk, but it's the risk both ways today. And it's just when does that currency stabilise? As you saw from the chart, it's only gone one way for a sustained period of time, so the farmers are still infinitely bearish. A lot of the trigger points seems to be around what happens with the election, but I struggle to see that's going to completely change the farmer's decision. And there's also, even more they might start to dump meal onto the market, they've got around about 1.5 million tonnes of inventory that they've built they really shouldn't have today. Reality is that that won't completely change the world. One of the bigger connotations that you look towards further is the situation for plantings this year. The peso is already affecting that. That very weak peso is making cost of production far higher for those guys. So they are going to be scaling back on the inputs they put down. So even if the peso does come off, we may see a slug of selling coming through, but a more normalised Argentine crop is unlikely to come through for another 2 to 3 years. Brazil, on the other hand, can make up for that. So I think that we can see that bearishness. But it's a huge trigger point, and it means a grains analyst's job is far more Argentine, and specifically looking at soy meal, is far more Argentine political expert than anything else, and certainly not that. So it makes it more difficult.
Okay, time for one more quick one, if anybody's got one. Yep, right here in the middle. Must be you again, Jenny.
Guy Smith, Essex farmer. Good paper, well done. I was struck by one comment though. You said in the longer term the weather becomes average. Where does that leave climate change? Because I've forgotten what average weather is.
I think from a climate change perspective, a lot of the meteorologists that we work with are that near-term climate change and what we're seeing is actually a boost to longer-term production. Because what we're generally seeing all around the world is an increase in the size of the growing window. So if you look specifically to the north of the US, North Dakota, South Dakota, those regions of the world traditionally wouldn't have ever been able to plant corn and soybeans because their growing window was never long enough. We are, though, seeing better in situation there in terms of what they can grow. So whilst there are certainly anomalies that are causing short-term volatility in the market from some of the climate shifts that we are seeing, there should be an underlying positive. Longer term, though, it certainly is a poor thing now, because as average temperatures increase, you will see the detrimental impact. So I think from the meteorologists that we worked with, I think on average through the near term there's positives. Obviously more volatility in weather adds more volatility to the market, but largely a lot of this volatility has not just been driven by the weather, but the concurrent effect of low stockpiles. But I think that's an interesting thesis that we work with for the near term at least.
Okay, thank you very much indeed, ladies and gentlemen. We're smack on time, so let's keep there.